What if I told you the biggest risk in trading isn't the market? It's your own fear of uncertainty. You've felt it before. You hesitate on a setup you've seen 100 times. You panic sell because of a sudden red candle. You know the pattern, yet you still let the unknown overpower your plan. That fear, the fear of risk, has ruled humans for centuries. But here's the twist. Risk didn't always exist as we understand it now. And if you don't understand where it came from, you'll never master it in your trading. You begin in the ancient world, where the dominant force wasn't logic, it was superstition. Risk wasn't something to be calculated or managed. It was the wrath of the gods. The unknown was explained through myth, not probability. You relied on omens, stars, and divine will. Traders, or their ancient equivalents, merchants, gamblers, warriors, didn't operate with forecasts. They prayed. If you lost money, you had sinned. If you gained wealth, it was a blessing. Cause and effect were mystical. And in a world where randomness was divine punishment, you didn't learn from mistakes. You begged not to repeat them. This is where Bernstein begins your journey. Because if you trade today without understanding this historical lens, you'll subconsciously treat risk like a punishment, not a tool. The shift came painfully slow. The seeds of change were planted when humans began to ask, what if chance isn't divine? What if it's mathematical? The first crack in the armor of superstition came with gambling. Dice games, cards. These weren't just entertainment. They were the crucible in which probability theory was born. People started to notice patterns. If I roll a die enough times, 6 should appear roughly 1/6 of the time. It sounds obvious to you now, but back then, that was a revolutionary realization. It said, the future might be uncertain, but it's not unknowable. Bernstein walks you through how slow and painful this evolution was. Even the earliest gamblers didn't understand odds the way you do. In fact, for thousands of years, humans refused to believe the world ran on chance. Why? Because randomness strips you of control. It's uncomfortable, and you as a trader know this too well. The desire for certainty is a psychological trap. You want to believe the market will reward good behavior every time, but it won't. And like those early humans, your brain wants to blame something. Bad luck, market makers, even fate, rather than accept variance. It took the Renaissance to crack the code. The rebirth of science and reason began to challenge the divine narrative. Trade was booming. Merchants had to make decisions under uncertainty. Should I send a ship loaded with goods to India? What's the risk it sinks? Now, these weren't just philosophical questions. They were financial ones. And you're seeing the parallel already. This is your daily trade decision. Do I take this setup? What's the risk reward? As traders in the Renaissance demanded better answers, thinkers like Girolamo Cardano, himself a gambler, started quantifying odds. He didn't just bet on outcomes, he calculated the likelihood of those outcomes. It was crude, but groundbreaking. Bernstein frames Cardano as a bridge, halfway between the old world of fate and the new world of numbers. And from here, the door opens. It sets the stage for you to stop treating risk as a fear and start treating it as a variable. Because the key to mastering risk isn't eliminating it. It's knowing that risk is the price of opportunity. Every trade you take is a controlled exposure to the unknown. The question is no longer, will I win? It becomes, can I afford to be wrong? You now stand on the shoulders of these early thinkers, whether you know it or not. Every time you set a stop loss, you're honoring this intellectual revolution. You're not throwing your fate to the gods. You're defining your exposure. You're quantifying your vulnerability. That alone makes you powerful. So before you go looking for the next indicator or backtest strategy, ask yourself, do I actually understand risk? Or am I just hoping the gods are kind today? Because understanding the roots of risk is the first step to building discipline. Without it, you're just gambling with a trading platform. You're no longer chained to fate. In the last chapter, you stood with ancient traders who feared the gods. Now you step into a world where thinkers begin to shape the unknown. This is the invention of risk as a tool, not a threat. Imagine for a moment that someone handed you a new lens, a way to see uncertainty not as chaos, but as structure. That's what the Renaissance did for risk. Enter Leonardo Fibonacci. Yes, that Fibonacci. The one whose retracement levels you've probably used without even knowing who he was. But before traders used his sequence to find entry points, Fibonacci was introducing Europe to the Hindu-Arabic numeral system. And that mattered because it allowed calculations, real, scalable mathematics. Trading without numbers is like driving blind. Thanks to Fibonacci, Western Europe could finally track patterns and apply logic to business, to risk, to trade. You were no longer shouting at the sky. You were writing in ledgers. Bernstein emphasizes that it's not just the tools, it's the shift in mindset that changed everything. When you begin to see patterns, when numbers replace mysticism, your relationship with the unknown transforms. Think of how you feel when a backtest lines up with your intuition. There's power in pattern. But the birth of this logic wasn't clean. There was resistance, and it took rebels to break through. That's where Girolamo Cardano re-enters the picture. Cardano was a physician, mathematician, and compulsive gambler. He documented the rules of probability long before it was called that. He noted odds, fairness, and expected outcomes. Sound familiar? You now use risk-to-reward ratio like a mantra, but Cardano was the one counting card combinations in the 1500s, writing, "In all cases, one must consider the number of ways in which the favorable outcome can occur." That's your edge today. Defined, measurable, repeatable. Here's where the emotional contrast deepens. Most traders today have tools, but still act like the world is ruled by luck. You have Fibonacci levels, ATRs, win rates, yet when a trade fails, you feel cursed. You panic. You abandon logic. Why? Because tools are meaningless unless you trust them. And trust is built by understanding where they came from. These Renaissance thinkers weren't algorithmic robots. They were emotional, curious, often flawed humans trying to conquer chaos. They remind you that risk isn't just a mathematical idea, it's a philosophical one. To apply risk as a tool means you willingly engage with uncertainty. You don't hide from it. You don't try to beat it. You measure it. You adapt to it. That's what Cardano did when he bet on dice. That's what you do when you size a position based on volatility. Bernstein leads you to another quiet revolution, the idea of fairness in outcomes. Cardano was the first to really define what a fair game looked like. In trading, fairness isn't about justice, it's about symmetry. If you win $2 for every $1 you risk, and you win half the time, your game is fair. That's equity. But so many traders confuse fairness with predictability. You say, "This setup failed, it's not fair." But fair never meant guaranteed. The invention of risk as a tool is the moment human beings began to take responsibility. No more blaming the gods. If your ship sank, it wasn't fate, it was a miscalculated probability. If your trade fails, it might not be the market's fault. It could be your risk model. That's accountability. And it's painful, but it's also freedom. Because when you control the variables you can, position size, stop loss, entry timing, you liberate yourself from those you can't. Fibonacci gave you the numbers. Cardano gave you the method. And together, they handed you a gift. The power to act rationally in an irrational world. But here's the catch. You must choose to use it. This is the turning point most traders never reach. They collect tools but ignore the philosophy. They obsess over entries but avoid the question, what does it mean to engage with uncertainty on purpose? Because that's what trading is, a constant dance with risk, not a battle to win, a process to respect. So the next time you measure risk-reward, draw Fibonacci levels, or calculate expected value, remember, you're using tools forged over centuries. Use them with intention. Use them with honor. Because the moment risk became a tool, it stopped being a curse. You've learned to see risk as a tool. Now, you need to know how to use it to make decisions. That's where you meet two minds who changed everything. Blaise Pascal and Pierre de Fermat. Not traders, not economists, mathematicians. But without their collaboration, you wouldn't have expectancy or the mathematical backing to decide which trades to take and which to skip. Their correspondence in the 1600s created something essential, the foundation of probability theory. Imagine this. A gambler writes to Pascal, frustrated about how to split winnings in an interrupted game. There are no rules, no math to lean on, just intuition and argument. Sound familiar? Every time you try to exit a trade too early, every time you hesitate mid-trade, that same lack of structure eats away at you. But Pascal doesn't accept ambiguity. He writes to Fermat. They exchange a series of letters. They invent a concept that changes the game, the mathematical expectation of outcomes. Expectation is not prediction. It's not asking, will this trade win? It's asking, if I take this trade 100 times, what will I average? It's the heartbeat of your edge. The idea that multiple outcomes must be weighted, valued, and averaged to guide your action. That's what Pascal and Fermat built. Before that, you were gambling. After that, you had a compass. Think of how this applies to your trading today. You have a strategy. It wins 55% of the time and yields 2-1 on winners. That's positive expectancy. And yet, after 3 losses in a row, you hesitate. You doubt. Why? Because emotionally, you live in the moment, but probability lives in the aggregate. That's what Pascal was trying to teach you. You don't judge the coin on its current flip. You judge it by the sequence. Bernstein emphasizes this shift. He wants you to feel how radical it was. Before this, decisions were moral or divine. Now, decisions could be calculated. Risk was no longer just controlled, it was programmable. You could structure decisions under uncertainty. And that's all trading is. You're not trying to win every trade. You're trying to win across time. You're trying to let math guide emotion, not the other way around. But it's not just a numbers game. It's psychological warfare. You're wired to feel each loss as a failure, even if the math says otherwise. That's where expectancy saves you. It tells you, keep going. You're aligned with probability. But here's the trap. Most traders ignore it. They crave certainty. They want every trade to be a winner. So they tweak systems, jump strategies, sabotage setups, all because they forget what Pascal knew. Expectation is not certainty. It's calculated risk. Pascal didn't stop with probability. He went deeper, into Pascal's wager, a philosophical argument that asked, if belief in God costs little but delivers eternal reward, isn't it rational to believe even without proof? That logic applies to you. If trading discipline costs you some discomfort now, missed trades, delayed gratification, but builds long-term profits, isn't it rational to stick with it, even during drawdowns? The expectancy framework demands that you look past the present. You stop asking, did I win? And start asking, was that a good decision given the data? That's emotional maturity. And it's rare, because it means accepting that some good decisions lose and some bad ones win. If that bothers you, congratulations. You're human. But if you want to trade like a professional, you must transcend that instinct. When you trade without expectancy, you become reactive. You chase, you tilt, you sabotage your edge. But when you internalize Pascal and Fermat's logic, you realize the only thing you can control is the process, not the outcome. And that's enough, because when you align your behavior with expectancy, profits become inevitable over time. This is where traders become traders, when they shift from hoping to calculating, from fearing to expecting, from reacting to executing. So ask yourself, do you know your system's expectancy? Have you tested it? Can you articulate why it works? If not, you're flying blind. You don't need to predict the future. You need to structure your decision-making to survive the future. That's what Pascal and Fermat gave you. Not a crystal ball, but a formula for endurance. By now, you've started to understand that not all risks are created equal. Pascal and Fermat taught you how to weigh outcomes, but a deeper insight was still missing, how those outcomes feel to you. Because you don't just manage money, you manage emotion. And that's where Daniel Bernoulli changed the game. It's the 1700s. Bernoulli is facing a paradox. Imagine someone offers you a gamble. Flip a coin, and for every heads, your prize doubles. $2, $4, $8, $16, and so on, with no end. Mathematically, the expected value is infinite. So why wouldn't you pay $10,000 to play? Because deep down, you feel that it's not worth it. The risk overwhelms the gain. That emotional discomfort, that's the core of what Bernoulli called utility. Here's what Bernoulli proposed. Money isn't linear. A gain of $1,000 doesn't feel twice as good as $500. And losing your last $1,000 hurts more than losing the first. You already know this in your trading account. A 5% loss after 5 green trades feels survivable. But a 5% loss when you're already down 15%, it feels fatal. Bernoulli gave you a way to model that behavior. Risk isn't about numbers. It's about how those numbers affect you. Bernstein drives this home. He doesn't just present Bernoulli as a mathematician. He presents him as the inventor of personalized risk. Before him, people acted as if all money was equal. But Bernoulli showed that risk is relative. It depends on your situation, your goals, your psychology. Just like today's trader must size positions based on account size and pain tolerance, not just setups. This is where your discipline is born, not from the charts, but from knowing what you can emotionally handle. And here's the wake-up call. Most traders ignore this. They trade like machines, but feel like humans. They size positions too big. They hold through drawdowns without clarity. They revenge trade, not because they're undisciplined, but because they haven't integrated utility into their strategy. Bernoulli's framework is now baked into every serious risk model. It's the basis for the Kelly criterion. It's how investors structure portfolios. But for you, the retail trader, it offers something more important: permission to not risk everything. You don't have to go big or go home. You just have to survive, size rationally, and execute with emotional safety. Compare this to Mark Douglas in Trading in the Zone. Douglas says, your job is not to be right, it's to execute flawlessly. But what prevents flawless execution? Fear. And what creates fear? Risk that exceeds your personal utility curve. When your position size threatens your emotional equilibrium, you can't follow rules. Bernoulli explains why. Douglas shows you how to fix it. This is why traders must stop copying others blindly. You can't just mimic a professional's trades if your utility curves don't match. What feels like a small dip to them might feel like devastation to you. And that's not weakness. That's reality. Bernoulli teaches you to embrace that subjectivity and build systems around it. So the next time you build a trade plan, don't just calculate risk-reward. Ask yourself, how much of this loss would I feel? If the answer is panic, then reduce size, widen stops, do whatever it takes to preserve your emotional capital. Because without it, your financial capital is already gone. You're not a robot, you're a risk manager. And that means tailoring every setup, every bet, every decision around your psychology. That's not softness, that's mastery. Bernoulli's lesson is one of the most important you'll ever learn in trading. The best trade isn't the one with the highest potential. It's the one that fits your emotional reality. Because no edge survives when fear takes the wheel. You've accepted that risk is personal, that your emotional threshold defines how you engage with the market. But what if the very structure of your thinking is biased by patterns that seem predictable, but aren't? What if the models you trust are built on illusions of certainty? That's the danger you face as you now enter the world of statistics and the seductive pull of the bell curve. Bernstein shows you how, in the 18th and 19th centuries, thinkers like Gauss and Laplace developed the statistical tools that still dominate your charts today. Standard deviation, normal distribution, correlation. You've used them, maybe even built strategies around them. But here's the problem. The bell curve is a model, not a mirror. It doesn't reflect the real world of markets. It simplifies it. The bell curve assumes most outcomes cluster around the mean, that extremes are rare. But you know that's not how the market works. Black swan events, flash crashes, parabolic rallies. They happen more often than the math says they should. So why do you still trust the curve? Because it feels safe. Statistics offer you a comforting illusion that if you control for enough variables, you can predict behavior. You backtest, you quantify, you build assumptions. But when real volatility hits, those assumptions break. Why? Because markets are not normally distributed. They're fat-tailed, emotional, reflexive, just like you. Bernstein warns you not to fall into the trap of statistical overconfidence. It's a mental shortcut. You see a mean and assume reversion. You see volatility decrease and assume safety. But history doesn't move in neat, curved lines. It leaps, spikes, collapses. You saw this in 1987, in 2008, in 2020. The models failed. The tails wagged the curve. And here's the danger in your trading. When you rely too heavily on normal, you underprepare for the extreme. You use tight stops, you over-leverage, you assume stability. Then a candle rips through your assumptions, and your strategy becomes your downfall. Bernstein doesn't reject statistics. He respects them, but he shows you they are tools, not truths. You must understand their limitations. The bell curve helps you measure, but it should never define your expectations. Because trading is not about the most likely outcome. It's about surviving the unlikely. Compare this with Brett Steenbarger's work. He teaches that market psychological ecosystems, they evolve, adapt, mutate, and you must do the same. That means being aware of statistical models, but never enslaved by them. The best traders aren't the best quants, they're the best adapters. So how do you apply this? First, you stop assuming the past will repeat exactly. Just because something has worked 80% of the time doesn't mean it's immune to the 20% that can kill your account. Respect the tail risks. Plan for the anomalies. That's where real discipline is forged. Second, you expand your models. Don't just look at standard deviation. Consider skew. Don't just rely on mean reversion. Account for momentum. Use Monte Carlo simulations. Stress test your strategies. Ask, what happens if my assumptions fail? Because the market doesn't care about your averages. It cares about your resilience. This section of Bernstein's work is a mirror. It forces you to confront the gap between theory and reality, between what's expected and what's experienced. And that gap is where most traders lose everything, not because their system was flawed, but because their belief in its infallibility was. So the next time you see a bell curve, ask yourself, am I preparing for the average or protecting against the extreme? Because the tail is always wagging. And if you ignore it, you'll find yourself unprepared when the improbable becomes your new reality. Risk doesn't live in the center of the curve. It hides in the edges. That's where the market hunts. And that's where you need to be watching. You've been taught to believe in systems, expectancy, probability statistics. But what happens when those systems are stretched by something no model can capture? Human nature. As you move from the precision of mathematics into the messiness of economics, Bernstein reminds you that risk doesn't just exist in a vacuum. It exists in markets. And markets are moved by people. And people are anything but predictable. This is the evolution of risk in economics, from Keynes to the chaos of modern financial systems. John Maynard Keynes didn't just talk about money. He talked about uncertainty. Unlike classical economists who assumed people acted rationally, Keynes saw what you see every day on the charts: panic, euphoria, greed, denial. He understood that risk isn't a function of clean numbers, it's a function of dirty emotions. Think of Keynes's famous line, "Markets can remain irrational longer than you can remain solvent." That should be tattooed on every trader's hand, because it reminds you that models don't guarantee outcomes. They only frame them. And even then, they often fail. Keynes rejected the idea that probabilities could fully capture economic behavior. Instead, he introduced animal spirits, emotions, instincts, urges that drive people to make irrational financial decisions. Sound familiar? That's your trading day. You have a plan. You have data. And yet, in the middle of a dump or pump, all that goes out the window. Why? Because you're not just calculating, you're feeling. Bernstein shows you how Keynes gave economists permission to treat uncertainty as real and unquantifiable. Unlike the clockwork certainty of earlier economic models, Keynes accepted that the future is unknowable, not just unknown. That's crucial for your trading mindset. You keep trying to predict. But what if your job isn't to predict? It's to position yourself wisely in the face of unpredictability. This is the turning point. Risk becomes dynamic. It's not just about probability. It's about changing probabilities. Market behavior evolves. News shifts sentiment. One candle can flip the entire landscape. And if you're stuck in yesterday's expectations, you're already behind. Compare this with the teachings of Mark Douglas again. He taught traders to think in probabilities, yes, but also to detach from outcome. That detachment isn't apathy, it's agility. It's knowing that the market doesn't owe you a clean resolution. It only offers constant, chaotic feedback. Keynes understood this deeply. But here's the paradox. In your pursuit of control, you must accept how little control you really have. This mindset is what separates consistent traders from dreamers. The dreamers want certainty. They want the trade that always works. The consistent traders want adaptability. They know risk isn't about prediction. It's about preparation. You prepare for the emotional impact. You prepare for the structural collapse. You build systems that survive storms, not just sunny days. Bernstein doesn't stop with Keynes. He guides you through how post-Keynesian thought attempted to grapple with these complexities, trying to formalize human behavior into economic equations. But no matter how refined the math became, the randomness of psychology kept breaking the models. And that's your wake-up call. You can't eliminate human nature from the market, so you have to integrate it into your strategy. That means creating rules not just for entries and exits, but for behavior. That's why Steve Ward, in Trader Mind, urges mental rehearsal, mindfulness, and state control. Because your edge isn't just in your setup. It's in your ability to stay rational when everyone else is losing it. So how do you apply this? First, accept that the market is not a machine, it's an organism. Second, build flexibility into your system, not overfitting, not chasing, just the humility to know that today's conditions might not match yesterday's patterns. Third, regulate your emotional environment, daily journaling, post-trade analysis, mental resets. These are your new risk tools, because here's the truth. You're not trading the market, you're trading people. And people are unpredictable. And when you start seeing economics as the fusion of numbers and nerves, you stop trying to win every trade. You start trying to win the game of staying in the game. That's what Keynes taught you. That's what Bernstein drives home. Risk isn't a puzzle to solve. It's a storm to navigate. And survival always beats prediction. Now you enter a new era, one where risk transforms from something abstract and philosophical into a tactical advantage. This is where strategy meets structure. Welcome to the world of portfolio theory, where Harry Markowitz gives you a way to make risk work for you, not just avoid it. Before Markowitz, investors didn't really diversify in any meaningful way. They chased returns, followed tips, bet big on what felt right. Sound familiar? That's how many retail traders operate today. Overexposed, emotionally tied to individual assets, with no systemic control. But Markowitz asked a simple, powerful question. What if risk could be distributed intelligently to increase reward? That question gave birth to modern portfolio theory, MPT. His insight? It's not just the risk of a single asset that matters. It's how that asset behaves relative to others. In your terms, it's not about the volatility of a single trade, but how your whole system behaves under pressure. Markowitz proved that by combining uncorrelated assets, you could reduce overall portfolio risk without sacrificing returns. This is how institutions manage money. And if you're not applying some version of it, you're playing defense with no formation. Think about it. A trade that looks risky in isolation might be the perfect hedge in a diversified structure. A slow mover might be boring, but when paired with a volatile asset, it stabilizes your returns. That's the genius of Markowitz. You stop thinking in silos and start thinking in systems. Bernstein highlights this as a crucial turning point. It's the moment risk goes from being a constraint to a lever. You don't just manage it, you design with it. You craft portfolios not based on prediction, but on correlation, variance, and probability. You're engineering resilience. But here's where it gets deeply psychological. Because diversification is boring. It doesn't deliver dopamine. It's not sexy. Traders want action. They want the big hit. But that craving is your downfall. Diversification forces you to sacrifice short-term excitement for long-term consistency. It demands discipline. And discipline, as you've learned, is rare. This ties directly into Jared Tendler's The Mental Game of Trading, where he breaks down how greed and fear disrupt logical thinking. When you concentrate your trades into a single asset or setup, you magnify emotional exposure. A single bad trade becomes catastrophic. Diversification doesn't just protect capital, it protects clarity. So how do you apply Markowitz's insights without being an institutional investor? Start small. Build a watch list that includes uncorrelated strategies, momentum, mean reversion, breakout. Spread risk across timeframes. Don't let one trade define your day. Think like a portfolio manager, even if you're just managing a few trades. And here's the most critical shift. Stop asking, will this trade work? Start asking, how does this trade fit into the system? That's the question Markowitz trained the world to ask. This approach also ties into risk budgeting. You allocate your emotional and financial capital with intention. You stop going all in on one idea. You start thinking in layers, core holdings, speculative trades, protective assets. Every piece plays a role. Every trade has context. Bernstein shows how revolutionary this was. Before Markowitz, investing was an art, or worse, a superstition. After him, it became an architecture. And you? You're the architect. Every chart you study, every entry you plan, it all feeds into the structure. But don't be fooled. Portfolio theory doesn't eliminate losses. It just ensures that no single loss breaks the system. That's the goal, not invincibility, durability. So the next time you take a trade, ask yourself, what's my system? If you don't have an answer, you're gambling. But if you know how each move connects to the whole, you're trading like a professional. And professionals don't bet the farm. They build portfolios that can survive the storm. Risk isn't your enemy. It's your raw material. And when you shape it wisely, it becomes your edge. You've been taught to diversify, to allocate, to think systemically. But what if your models are too clean? What if the very math you use to manage risk gives you a false sense of control? That's the danger hiding in the elegance of the Black-Scholes model, the seductive formula that nearly broke the financial world. Bernstein brings you to the 1970s, where Fisher Black and Myron Scholes create a mathematical framework that forever changes how traders price options. Suddenly, uncertainty has a price. You no longer guess a fair value. You calculate it. For the first time, risk could be engineered. The market moves, and you adjust your delta, hedge your exposure, flatten the curve. Precision, control, confidence. And that's where it starts to go wrong. Because Black-Scholes was built on assumptions. Rational actors, log normal price distributions, constant volatility, frictionless markets. But you know that none of these exist in the real world. Humans are irrational. Prices gap. Volatility explodes. Liquidity vanishes when you need it most. The model worked beautifully until it didn't. The elegance of the formula gave birth to an illusion that risk could be tamed completely, and traders bought in. Entire institutions built portfolios on it. If the model says it's safe, it must be safe. That mindset nearly caused catastrophe. You saw it in the 1987 crash. You saw it again in 1998, when long-term capital management, run by Nobel Prize winners, imploded because their models assumed the world was more stable than it was. And you, as a trader, face this same danger. You use indicators, algos, scripts. They give you a sense of control. But if you stop questioning their assumptions, you're no longer trading. You're worshiping math. That's not discipline. That's delusion. Black-Scholes isn't evil. It's brilliant. But it's a tool, not a prophecy. Bernstein doesn't reject the model. He simply reminds you, models are only as useful as your understanding of their limits. They are maps, not the terrain, just like your trading plan. Think of how often you overfit. You test a system on historical data. The equity curve looks perfect, but then the market changes and it all falls apart. Why? Because your assumptions didn't hold. You ignored the fat tails, the unexpected volatility, the reflexivity of traders reacting to each other. That's the same flaw Black-Scholes had. It ignored feedback loops. This is where your self-awareness must evolve. You stop asking, is this model right? And start asking, what happens when this model is wrong? That question is your edge. Because when the crowd builds their confidence on fragile assumptions, the prepared trader thrives in chaos. Compare this to Nassim Taleb's Fooled by Randomness or the Black Swan. He warned against the same thing Bernstein highlights, mistaking precision for truth. In markets, it's not what you know that hurts you. It's what you think you know, but don't. So how do you protect yourself? First, don't use models to eliminate risk. Use them to reveal it. Second, stress test everything. Ask, what's the worst-case scenario? Not the 95th percentile, the outlier. Plan for the tail. Third, keep your ego out of the model. The more confident you are in a formula, the more dangerous it becomes. And finally, watch behavior. Markets don't crash because of numbers. They crash because of behavior driven by those numbers. In 1987, traders all using the same hedging strategy triggered a cascade. In 2008, models overvalued mortgage-backed securities. The math was clean. The emotions were not. Bernstein's lesson here isn't to abandon structure. It's to fear false structure. Anything that offers certainty in an uncertain world deserves skepticism. Black-Scholes gave the world a tool, but too many mistook the tool for truth. And you can't afford to make that mistake. Because in trading, it's not what the model says, it's how you react when the model breaks. So trust the math, use the models. But never forget, markets are alive. And the map is not the territory. You've seen the rise of models, and how even the most elegant formulas can crumble under pressure. Now it's time to face the harshest reality of all. The enemy isn't just flawed math or unpredictable markets. It's you. Your brain, your instincts, your biases, and no model will save you if you don't learn to see yourself clearly. This is the revolution of behavioral finance. Bernstein brings you into the world of Kahneman and Tversky, the psychologists who tore apart the myth of the rational investor. They proved that people don't make financial decisions based on logic. They make them based on fear, overconfidence, loss aversion, and mental shortcuts. Sound familiar? You experience all of it. Every trading session. You freeze on a breakout because of past losses. You chase a setup because you feel it's about to go. You cut winners too early and let losers bleed because your brain is wired to survive, not to trade. Behavioral finance puts a mirror in your face. It says, you are not as rational as you think, and until you accept that, your edge will always slip through your fingers. Kahneman's concept of loss aversion is brutal. People feel the pain of a loss twice as intensely as the joy of a gain. That's why you break your plan to avoid a red P&L. Why you hesitate to size up even with an edge. Why you sabotage exits. The pain of losing overpowers logic. It's not weakness, it's biology. Then there's confirmation bias. You seek information that supports your existing beliefs. You enter a trade and then only read signals that affirm it. You ignore divergence, resistance, volume drops because you want to be right, but wanting to be right costs you money. Being flexible makes you profitable. And recency bias. When your last 3 trades were losses, you assume the next one will be too. You shrink, you second guess, or you overcompensate with a revenge trade. Either way, you've surrendered to bias, not data. Bernstein doesn't just cite these ideas to scare you. He wants you to wake up. Your trading decisions are only as strong as your self-awareness. Without it, even the best strategy won't save you. Compare this with what Mike Bellafiore teaches in One Good Trade. He doesn't just train traders to find setups, he trains them to track themselves. He has traders journal, review, record, reflect. Because if you don't know your mental patterns, they will own you. So how do you integrate behavioral finance into your trading routine? Step 1, build a bias audit. Every trade plan should include not just technicals, but emotional risk. What am I feeling right now? Am I chasing? Am I avoiding risk because of a recent loss? Step 2, review not just what you traded, but why. Was it your system or your impulse? And step 3, create disruption rituals. Something to reset your state when emotion starts to build. Deep breath, walk away, verbal pattern interrupt. Because this is the paradox. You are the source of your edge and the biggest threat to it. Kahneman later wrote in Thinking Fast and Slow that humans operate on 2 systems: fast, instinctive, emotional thinking, and slow, deliberate, logical thinking. Trading demands you master the slow system, but under pressure, you default to fast. That's why you need process, checklists, pre-trade routines, anything that keeps System 2 in charge when System 1 tries to hijack the wheel. And don't expect to beat this once. You won't. Behavioral bias isn't a flaw to fix. It's a force to manage. Every day, every trade. Like volatility, it doesn't go away. You build a strategy around it. Bernstein ends this section with a sobering truth. The models failed not just because of math, but because humans believed in the math too much. They stopped thinking. They outsourced responsibility. And that's your final warning. No tool, no signal, no mentor can save you from your own undisciplined mind. You are your system. You are your risk manager. And if you don't know your biases, they will run your account. So build your edge, build your plan, but build your self-awareness first, because that's the only edge that lasts. You've walked through centuries of evolution, from superstition to strategy, from guesswork to models, from ancient gambling tables to high-frequency algorithms. But now, in this final stretch, Bernstein leads you to the truth that every serious trader must accept. Risk is not something to conquer. It's something to live with. Risk is life. You may have started trading to find freedom, financial, emotional, creative. But that freedom comes at a cost. Uncertainty. You wake up every day to a market that doesn't care about your plans, your needs, or your analysis. No setup is guaranteed. No edge is permanent. The only constant is risk. And that's not a flaw in the game. It is the game. Bernstein doesn't give you a formula in the final chapters. He gives you a lens, a way to see risk as not just something to calculate, but something to embrace. And this changes everything. You're not trying to eliminate risk. You're trying to create a life where uncertainty is not your enemy, but your companion. Look at how you behave during a drawdown. You get tense. You question your edge. You wonder if you've lost your touch. But here's what Bernstein reminds you. Drawdowns are the system. Volatility is the process. Losses are not errors. They're inherent. And when you truly accept that, your entire mindset shifts. Compare this to what Mark Douglas says. Anything can happen. You don't need to know what's going to happen next to make money. That's not just philosophy. That's the blueprint. Your job is not prediction, it's execution under uncertainty. That means loving the process more than the outcome. Because if you can love the process of managing risk, of following your plan, of growing your awareness, then profits become a byproduct of your discipline. Risk, then, is not a threat. It's a teacher. It teaches you patience, because rushing creates chaos. It teaches you humility, because no one, not even the best, is bigger than the market. It teaches you responsibility, because every click is a choice. And over time, if you pay attention, it teaches you to become something more than just a trader. It teaches you to become resilient. That's what Bernstein meant when he titled the book Against the Gods. Risk is the defiance of fate. It's the human ability to say, I don't need to know the future to take action today. And that's what you do every time you place a trade with a defined plan. You're not gambling. You're asserting control within chaos. You now understand what most will never see. That risk isn't a bug in the system. It is the system. And your edge doesn't come from eliminating it. It comes from managing it better than the next trader. It comes from acting consistently in a world built on inconsistency. And when you internalize this, really live it, you stop being afraid of losses. You stop chasing certainty. You stop sabotaging your edge for emotional relief. Instead, you show up each day, focused, intentional, present. You become the kind of trader who can thrive in any condition. Not because you control the market, but because you've learned to control yourself. Risk will never go away, but your relationship with it can evolve. And when it does, you don't just survive in this business, you start to dominate it. This is what Bernstein wants you to understand. Risk isn't just a topic. It's your path, your mirror, your greatest adversary, and your greatest ally. And if you accept it fully, if you build your strategy, mindset, and daily habits around its presence, not despite it, but because of it, then you're no longer trading against the gods. You've become one of them. You've come a long way, from ancient superstition to modern markets, from the first dice games to dynamic risk models. And through each era, you've learned a single truth. Risk isn't something outside of you. It's within you. Every decision you make, every trade you take, every hesitation, every impulse, it's all a reflection of how you understand and respond to uncertainty. Peter L. Bernstein's Against the Gods is not just a history book. It's a psychology manual for traders. It shows you how your relationship with risk has been shaped over centuries, and how your survival now depends on honoring that legacy. You learned how the Renaissance sparked a revolution in probability, transforming fate into something measurable. You walked with Pascal and Fermat as they developed expectancy, the foundation of every trading system. You saw Bernoulli give emotion its place in finance through utility theory. You examined how statistics gave us tools and blind spots. You stood beside Keynes as he dared to say that uncertainty wasn't temporary, it was permanent. You built strategy with Markowitz. You questioned perfection with Black-Scholes. And finally, you confronted yourself through the lens of behavioral finance. The lesson is clear. You will never eliminate risk, but you can transform your relationship with it. So, where do you go from here? Start with awareness. Reread the chapters on expectancy and utility. Audit your own risk tolerance. Rebuild your trade journal, not just with price data, but with emotional triggers and cognitive biases. Then, test. Stress test your system for outliers. Expect the unexpected. And when the market does what it always does, shocks you, respond not with panic, but with process. Because that's what a trader with a risk philosophy does. So if this resonated with you, if you're tired of randomness ruling your trades and want to start ruling your process, like this video. Share it with traders still stuck in superstition. Drop a comment about which part of Bernstein's story changed your thinking the most. And make sure you subscribe, because this is just the beginning of your journey toward mastering not just the markets, but yourself. Risk is always there, but so is your ability to rise above it. Total section word count, 7,100 words, across 10 parts plus conclusion.